Hello and welcome back. We are here today for Module 2 of our financial empowerment classes. Again, my name is Leah Nelson, and we will just jump right in. So today we are going to go over credit. So understanding credit, and we're going to go over the main parts that I think that are important for everybody to know. So credit is often this big kind of scary thing to people because we aren't really taught about it. It's kind of a mystery to a lot of people. So we're going to go over a lot of the questions that you likely have about credit. So first of all, what is it and why does it matter? So your credit shows a history of your borrowing habits, your money borrowing habits. So if you've ever had a car loan, a mortgage, credit card, student loans, anything like that, it will show up on your credit. A history of your payments, if you paid them on time, if you didn't, things like that. And through this information, lenders, the people who are giving you the money, will determine how trustworthy you are and if they will lend to you. And that's what they base it off of usually. So your credit can affect your interest rates for car and home loans, credit card interest rates. It can affect even like your insurance premiums, like your car insurance premiums. Oftentimes they'll do a credit check and you can get a discount if you have a good credit, or sometimes you'll be charged more if you don't. And then qualifying for renting like an apartment or a home, townhome, anything like that. Most people will be looking at your credit. Oftentimes they'll have just a minimum credit score that they will require to even be able to rent it to you. So we're going to go over in the next slide, how is your credit score calculated? What do they even look at? So we have this broken down here. So 30% is the amount owed. So this is based on the amount that you have available. So if you have, a credit card where your credit limit is $10,000, but you're only using about $2,000 of that, every month, that will look better, right? So we call that the credit utilization rate. So it's how much you're using divided by how much you have available. And that is your credit utilization and your amount owed. That makes up 30% of how your credit score is calculated. 35% is your payment history. So that's the biggest chunk. It's the most important one. So paying on time, paying late, how late were you if you were late, things like that, that can really, really affect your credit score. And it is one of the main things that does affect people's credit scores. So below that, we have our credit mix, which is 10%. So that is kind of the types of credit we have. So a credit card would be considered revolving credit, meaning once you've paid it off, that then becomes available for you to spend again, right? And then we also have fixed credit. There's a different word for it. I can't remember it. Installment loans. So that would be like your car loan, your home loan, where it's the same amount every single month you're paying, and you just pay that until it's paid off. And then once it's paid off, like you don't have that available to you anymore, right? So car loan, home loan. So they're looking at the types of credit, and that makes up 10%. If you have a good mix of that credit, that's helpful. New credit is 10% of your credit score. So that is if you're constantly applying for new credit cards or new loans or things like that, that's going to hurt your credit score, right? So new credit can give you a little bit of a ding on your credit score. So they are looking at that. And then the last one is length of credit history, which is 15%. So this one, you don't have a lot of, control over. So like for me, for example, my credit history is not very long because I'm still pretty young, right? It's been not that long since I first took out my first credit. So sometimes that gives me a little bit of a ding, and I can't really, I don't really have much control over that, which is kind of unfortunate, but luckily it's not too much of a percentage of the credit score calculation. So that counts for 15%. So the longer history you have, the better that looks. Okay. This next one is what credit scores look like. So scores range from 300 to 850. So anything below 629 is considered poor credit. Anything between 630 and 689 is considered fair. 690 to 719 is considered good, and 720 or higher is considered excellent credit. So we want to be, our goal is to be 690 or above. And we're going to go over in the next slide a couple ways that we can work on boosting our credit score and making that number better, right? Okay. So how can I repair my credit? The biggest thing you can do to help your credit is to pay on time. That's the number one thing. Late or missed payments hurt you the most because, as we were looking at before, it's 35% of what they're looking at, right? So it's a large chunk. The next thing is don't continually seek out new credit, right? So we don't want to constantly be applying for new credit cards because that can hurt our credit score. And it can be good to help our history. To keep our history long is to keep old accounts open just to keep the history, right? So if we have a credit card we don't really use anymore, you can still keep that open and still not use it, but it will help your credit, right? Because you have that longer history of that credit card. Next one is you have to be patient. I wish there was this quick fix and you see, commercials or maybe hear about it on the radio that they can fix your credit really quick. That's just unfortunately not true. It just takes time, right? We have to build up that good credit and it takes time. The next one is to check your credit report for errors and dispute any errors if necessary. So how it works is our credit card company or the bank we have our car loan at, they will report to the credit bureaus, and that's where we get our credit report. And sometimes the reporting will be incorrect or something will come over kind of weird. So checking our credit report consistently can be really helpful in that we can catch those things if they report it incorrectly, and we can get that fixed, right? And that can help our credit score. So our next one is to keep our utilization rate low, which we were talking about. So it's total debt divided by total available credit, like we were saying. So how much credit am I using divided how much I have available? And we want to keep that under 30%. So we want to keep it relatively low. And that basically just shows lenders like, hey, we have it available, but we don't necessarily need it. It's just there. We kind of just got approved for that much. We're not necessarily, running ourselves into a lot of debt, right? So those are kind of the things that we can help do to help repair our credit if it's not looking so great, right? Okay. Next, how long will something stay on my credit? So like we said, credit history, it looks pretty far back. So this is the different things that stay on your credit history. So if you have a late payment, it will stay on there for 7 years, even if you pay the past due balance. So it will always say, if I had a late payment in, 2017 or something, it will still be on my credit, right? So the more on-time payments we pay after that, the better that looks. The next one is if an account goes to collections or is charged off by the company, meaning, they kind of assume that they're not going to be getting that money from you. That is also 7 years from the date of your first missed payment. So same thing for that. Bankruptcy. Now that's if you declare bankruptcy, right? It can be 7 to 10 years, depending on the type of bankruptcy. We won't get into that. There's a couple different types of bankruptcies that you can declare. And those will stay on 7 to 10 years, depending on the type. Now, the next thing is other negative things like repossession or foreclosure. Those will stay on there up to 7 years as well. So most of these things that are, that are not great for your credit, they stay on for about 7 years, most of them. So once 7 years passes, they'll drop off and it won't be affecting your credit score anymore. Now, the last one is hard inquiries. So a hard inquiry is what is considered, not what is considered. A hard inquiry is when you are applying for credit and someone checks your credit report. So if I'm applying for a mortgage and someone is looking at my credit report to determine my interest rate and things like that, that would be considered a hard inquiry, and that can ding your credit. It's usually not too bad, but it stays on there for about 2 years. So those things will stay on there, right? If you get a car loan or if you get a new credit card, Those things will stay on there 2 years. They don't really hurt your credit much unless you're consistently doing it a lot. Otherwise, it will ding your credit score. Your score might drop, a couple points. It's not a huge deal. Most of the time, companies realize, sometimes you're going to apply for credit, right? So that's how long things stay on your credit. This next thing is, how can I check my credit? So there are 3 credit bureaus, like we talked about: Equifax, Experian, and TransUnion. So these 3 are the major credit bureaus. This is who your credit card companies are reporting to. Sometimes even utility companies will report to your credit, or like your insurance company may report to your credit. It just kind of depends. Not all of them do, but pretty much if it's a credit card or any other type of loan, they will be reporting to the credit bureaus. So it could be all 3. It could be one of them. Most of the time, I think they report to all 3 of them. So you can check your credit score, your credit report, for free 1 time a year from all 3 of them. So you have 3 chances every year to look at your credit report. If you go to annualcreditreport.com, that is the place to do it. They will help you get your credit report, and then you can do that up to 3 times in a year, right? So once for each credit bureau. And it's like we were talking about before, it can be good to take a look at those just to make sure that everything's being reported correctly. You can also sometimes catch like credit card fraud on things like that. Like if there's something open that you didn't open yourself, if someone had opened something in your name, you can find it on there as well. So it's a great resource. You don't have to pay for it. You can just check it, kind of check up on it every couple of months, just make sure everything looks good. And one important thing to note is that checking your own credit does not affect your credit score. So you can check your credit really as many times as you want, and it won't affect your credit score. They know that, you're just kind of keeping an eye on it. So those are the main things with credit. It's a lot of information. If you have any questions, you can always reach out to me. I'm happy to kind of walk you through any questions that you have, or, if you are confused about something on your credit report, we can walk through that as well. I'm happy to help you out really in any way that I can. There's also a quiz for this module in the description of this video, so you can go ahead and take that. And then I will see you back here for our next module.